An interest rate cut by the Federal Reserve can have both direct and indirect impacts on consumers. At its most basic level, what the central bank is doing is adjusting the price of money. Reducing interest rates is designed to make borrowing money more appealing and saving money less appealing. Fed interest rate changes will have a direct effect on the prime rate, a benchmark for credit card rates, home equity lines of credit, personal loans, and some private student loans. A quarter-point interest rate cut will generally translate into a quarter-point reduction in your credit card rate, home equity line of credit rate, and any variable rate private student loans. Fixed-rate loans, such as personal loans and auto loans, will see lower rates as well, maybe not exactly 1/4 percentage point, but only for new borrowers. Consumers that already have fixed-rate loans are unaffected. The Federal Reserve's moves do not have a direct impact on mortgage rates, which often move well in advance of the Fed itself. By the time the Fed cuts their short-term interest rate benchmark, mortgage rates have long reflected the move. In fact, mortgage rates may now be moving based on expectations of what may lie ahead, either continuing to fall with the outlook for more interest rate cuts or rising on expectations of a strengthening economy or higher inflation. A Fed interest rate cut will reduce the returns that savers see on savings accounts, money markets, and certificates of deposit. Much like with mortgage rates, yields on CDs tend to move in advance of Fed action and tend to reflect the rate cut by the time it's instituted. Returns on savings accounts and money markets are more closely tied to when the Fed acts, so those yields will be falling in the weeks following a Fed interest rate cut. If you're a borrower, an interest rate cut is welcome news and will reduce interest costs on your future borrowing and possibly some of your existing debts. But for savers, unfortunately, the opposite is true, with an interest rate cut trimming the returns earned on safe investments like savings accounts and CDs, increasing the appeal of riskier, higher returning investments like real estate and stocks. This is how the Fed uses interest rates to influence economic activity through the pocketbook of consumers. To see all the latest rates and find the best deal for you, visit Bankrate.com.